Welcome to the NISM Masterclass. I am your host, Sashi Krishnan. Our purpose at NISM is capacity building for the securities market ecosystem. As part of that purpose, we sit down and talk to the gurus of the securities market to understand their journey and learn from their insights. I'm sure that all of you who tune into this masterclass session will gain significant insights that will hold you, in good stead in your financial journey. Uh, Today, my guest is CJ George. Namaskaram and welcome to this masterclass, George. Uh, George is the founder, chairman, and managing director of Geojit Financial Services. And George has seen this market for 37 years. And in that 37 years, he's had a very fascinating journey. He began his career, working for a broker in the Bombay Stock Exchange. But I understand that somewhere during his time in Bombay, there was a sense of dissatisfaction that he felt. And part of this dissatisfaction came from the fact that, he felt that investors weren't getting a very good deal. And more importantly, the way broking was structured in those days was more about trading than about investment. And so George packed up his bags and came back to his hometown in Kochi and decided to set up his own firm out here, which would keep these two fundamental principles as the cornerstone of whatever the firm did. And I think in the last 37 years, George has built up a franchise that covers literally every aspect of the securities market. Uh, so to begin with, George, it would be wonderful if you could share your journey with us, especially touching upon a couple of very very important milestones in this journey. The first, obviously, being the shareholding that KSIDC took in Geojit, because I believe that was a milestone more in terms of the fact that there are very few government institutions that have taken shareholding in broking firms. And then a little bit about the association that you had with Rakesh Junjunwala, which is a name that every single viewer of ours would have heard of and followed. And especially the fact that not only did Rakesh invest 14% into your company, he also was on your board for 12 years. And I'm sure there were a large amount of insights that you would have also gathered in your conversations with him. And finally, the stake that BNP Paribas took with you, because that again, in my opinion, is a milestone for the broking industry as a whole, because they would have been one of the first foreign institutions that took a stake in an Indian broking firm. So over to you, George.
Thank you, Shashi, for having me here. It's a pleasure to talk to you. Uh, I wouldn't like to call myself as a guru, but I'll be very happy to tell you my experiences in the market. The timing was something very important. That was the time, when I came to Cochin around that time, Mrs. Gandhi was assassinated, and then a new government came, and that government actually took a lot of initiatives from VP Singh as finance minister. So the markets also became very active.
Right.
In the year 1987 is the year Cochin Stock Exchange gave a new membership to individual stockbrokers. I applied and I got membership in the exchange. One thing we had decided right in the beginning that was we will be only in broking and no trading at all, no proprietary trading at all. Because my experience at that point in time was that brokers also did broking, or most of their work was basically on their own proprietary
Right,
investments.
right. Yeah.
So that was the beginning of the conflict of interest. So I haven't seen, at those days I'm talking about, I couldn't see anybody who is just focusing on broking, that is clients. Everybody was actively into their own investment, and then they will also
Do
be
something for the client.
something for the client. Uh, but one good thing at that point in time, what I noticed was that the investors, the clients, they used to take a lot of effort in studying which broker they should approach. The reason being there was no regulation,
Right.
practically, or very little regulation. So you are just out of trust giving your, cash or securities to a broker with no security, unlike what it is
Right.
today. So there was buyer beware was something that I actually saw from my eyes in the securities market those
Right.
days. Today, because of all the steps that SEBI has taken, investors have a feeling that they are fully protected and they don't have to be very careful. And so there is a
Investors' interests are now protected, whereas in
correct.
those days it was
It
a
was
more
not
much looser system.
correct.
Yes.
Correct. Um, and then you started with the KSIDC investment.
Right.
I must tell you that was the time post Harshat Mehta scam in the market. Uh, SEBI, not SEBI, Government of India came out with so many reports and then wanted to clean up the market system.
Mm-hmm.
And then NSE came into being.
Correct.
And then for NSE, till then we were doing Cochin Stock Exchange. Uh, there was, uh, you know, that was kind of a small operation. When NSE came with a membership offering that needed some significant capital,
Correct.
at that point in time,
KSIDC decided to join hands with you.
yeah, so we went to KSIDC, it was not simple.
Mm-hmm.
So KSIDC was not used to non-industry
Correct.
kind of investment.
Correct.
Uh, but interestingly, I must tell you, uh, the person who was MD of KSIDC is at that point in time is Amitabh Kant,
Okay.
and he was
He was broad-minded enough to say that financial
absolute,
services is an industry that will grow in this country, and
absolutely. It has to grow together.
correct.
Uh, so he was an broad-minded. He was a visionary sort of. He could foresee, it's also important or as important as industry kind of. And then they invested 50 lakh rupees uh,
With you.
with us in the capital, and that gave me sufficient capital to start, National Stock Exchange business.
Right.
So that is how the KSIDC
And they
and
continue to remain an investor with you till
absolutely
today.
they never participated when there was dilution, but they continued absolutely.
Remain.
Their MD is always on the board of the company, and that is the KSIDC story. And then your next question was
About
on
Rakesh
Rakesh
Jhunjhunwala,
Jhunjhunwala.
uh,
Yeah, Geojit was very active from the beginning of the uh, dematerialization of the uh, stocks, securities.
correct.
And by the time we were fairly known and we were listed in 1995, we were the first to start the online securities trading. So we created much of a noise. Uh, the market noticed us, perhaps. Also, I must tell you that we had taken a decision right from the beginning that we wouldn't be operating through sub-broker model.
Right.
So we will deal with the customers so that we manage customers' assets. We don't want an intermediary in between kind of. So we had to open branches. So we had more number of branches than anybody else in the country, etc. So it so happened that he contacted me. I didn't know him. He contacted me, and then we had a discussion, few hours of discussion, and then he decided to invest in the company. That is how the investment happened. And then we requested him, but can you also join the board of the company, so that we could basically take advantage of his knowledge and experience,
Correct.
which he agreed. And then the association continued till early 2018 or so. He was on the board. He is still, I must say that their holding is still intact. Uh,
I remember reading, Rakesh's letter to the Bombay Stock Exchange where he said that, I mean, I'm wholeheartedly still with Geojit, but I want to get off the board because I don't have time to devote.
Yeah,
I remember that
that's
letter of his.
that's right. That's right. He did say that. Also, we genuinely benefited from his insight regarding the securities market. You know, that is something that is undoubted and well recognized. We genuinely benefited out of it. And you asked me about what
Learned from Rakesh, in those years that he was on your board.
yeah.
This must have been very interesting board discussions that you had in those days.
Absolutely. One thing I must say, what struck me most, which is important for traders and investors to know also, his investment portfolio he doesn't touch for any kind of trading activity. When it comes to trading, what I have noticed is that he books losses and without any hesitation. Booking loss is part of his, kind of personal philosophy. This is what I have noticed. He wouldn't wait.
You're right. In fact, Rakesh has very often said that you need to treat your investment portfolio and your trading portfolio as two
Correct.
very separate businesses that you're looking at.
Correct.
And in a trading portfolio, if the trend is not moving in your favor, then exit. Book your losses and exit.
Absolutely. And this is very important for retail. Since we are in retail space,
Right.
I also, whenever I get an opportunity to talk to investors and clients who are in the market, I also talk to them on this point. That is, quite often our people make a big mistake, the retail people. They have invested their own money,
Correct.
they have not borrowed.
Right.
When the prices go down, they wait.
Right.
They wait and wait.
Right.
And only when they lose, 40% or 50%, they suddenly decide to sell. So
Correct.
that means they basically book the entire loss of the journey of the stock's decline.
Right. Right.
But the other way, what happens is when the stock prices go up, when it goes up by 10%, 15%, 20%, they try to take
Money off the table.
money off the table. They
Right.
book the profit. So, end of the day, what I have noticed is they take the full downward loss,
Right.
but in the case of upside, they get only minimum upside.
Correct.
Whereas I have seen Rakesh operating and advising, bottom you if you are losing, get out.
Right.
But if you are making money in a portfolio, if the company's stock is doing well, wait till you
Ride
get
the trend. Exactly. So in fact,
absolutely.
Rakesh kept talking about trend,
Yeah.
and following the
Yes.
trend.
Absolutely.
Correct.
And some of his investments, he held on to the investment for a long period of time and took full benefit of the upward
Right.
journey.
And then
So,
I asked you about BNP Paribas. Yeah.
yeah, um, it was around the same time, when Rakesh invested in Geojit and joined the board. Soon after that, uh, we were sponsors of a conference in Mumbai
Okay.
uh, on mutual funds. BNP Paribas also was a co-sponsor. So they approached us for a meeting, came down to Cochin. They were looking for a retail business where they could invest. Uh, so this came without any investment banker because we were not planning to
Get
look
into
for,
investment banking.
yeah, we were not planning to even, mobilize capital at that point in time. We didn't need capital at that point in time. So that was not in our horizon at that point. So when BNP Paribas came in, we thought it's very interesting. One of the most respected institutions globally in the financial services sector. Uh, and why not? it will benefit us. That was our view, and the entire board view also. And Rakesh and all, Rakesh gave full support that we must have an institution like BNP Paribas to be with you. So this started in discussion started in 2005 we end, and we signed up in 2007. uh, from 2007 to 2016, BNP Paribas was a strategic partner also. Our name was Geojit BNP Paribas. And then subsequently, when BNP Paribas acquired Sher Khan, a competitor,
Right.
um, they moved from strategic investor to the financial investor.
Right.
They continued to be a shareholder.
So that's a very interesting, what observation, George, that KSIDC, Rakesh, now Rare Earth, and BNP Paribas continue to be investors with you, even after 25 years. So, I mean, that goes a long way to say that, running a business which is investor centric, running a business which is, not so much trading oriented, actually, is something that financial investors look at, very positively.
Yeah, we were very disciplined and we were very compliance focused, and we were also not in a hurry. That I must tell you that has helped us, in gaining the trust of investors. So this is how
Sure.
all this relationship was
Yeah,
managed.
thanks, George, for that. Talking about the investors itself, investment preferences in India have for a very long time been towards property and gold. I mean, though household savings has seen a decline over the last 2 3 years. Today at 18%, household savings have declined quite a bit. Almost 13% of that entire household savings is in property or in gold, and just about 5% is in financial assets, right? Do you see this changing? And do you think that Indian households need to look more actively at putting money into financial assets rather than merely property, gold? And even in financial assets, believe me, 53% of that 5% is in fixed deposits. They're really not in, sort of risk assets that can grow wealth. And, one of the cornerstones of what you said is your purpose is creating lasting wealth for investors. How do they do that?
Yeah, interesting question. I think there is a perceptible change in that preference from households. Uh, it comes through, number one, through education. Number two, thanks to multi-year active, vibrant stock market, it has started attracting a lot of millions of new investors, particularly youngsters. So, in our point of view, what we notice today is that there is significant amount of allocation to equity markets happening from the households in comparison with property, but not as much as we see shift from gold to mutual funds or stock market. So there is a shift that we can see, and that is evident from the increase in the number of people who are investing in the stock market and mutual funds. So I think we have reached a critical mass today. Uh, from the current level, it will definitely go up only. I don't think it will, that number of people who are investing in the market, and luckily, uh, even pension funds and PF funds all are, directly or indirectly, the number of people who are now participating in the equity market has really gone up. That's good for the market also.
So, talking about how investors participate in this market, one observation is that most people, broking houses tend to offer financial products. They are product sellers, right? And I think the path that you have taken is financial solutions are what investors are looking at. So, how do you construct a financial solution for, say, your investors or your customers? Basis their risk appetite, basis their disposable income, basis their preferences, basis their financial goals. How exactly do you build a financial solution for them rather than just selling them a product?
Yeah, I agree with you. Selling product is something that can work only for people who are very savvy investors who know how to analyze, how to compare, and how to do a risk assessment, etc. But otherwise, we start with basic conversation with a customer, particularly if he's a new customer, and then we do kind of an assessment and then suggest. The
So could you
solutions to
just
them.
elaborate a little bit on this needs analysis which you do, George?
Yeah, for example, in our question, if you are talking about the financial plan or
Yeah, the needs
yeah,
analysis that you do while
yeah.
building out a financial plan for an
So we
investor.
have a regular financial plan building kind of
Cool.
a department also. So there it is basically goal-based financial planning, including retirement.
Okay.
So we ask them. This is basically a detailed question. We understand the assets, the liabilities, uh, the cash flows, and what are the immediate requirements. What are the
If I
medium?
may interrupt out here,
Yeah.
are your customers actually willing to share these kind of details with you? Because I do hear that from many financial advisors that many customers don't come up front and tell us a lot of the details that we require to build out a financial plan.
That is a challenge, I agree with you. But today, what I have noticed is the people who are coming today, the relatively 30 to 40 age group who are professionals, they are willing to disclose. They pay their full tax, they have nothing to hide. So they are ready to, this was the problem initially. Even we have a question in the KYC.
Mhm.
When we do KYC, what is your net worth?
Right.
What is your asset? So they don't disclose the right number. So we also ask multiple questions and then we make our own assessment. We also mark, our opinion also in the process. So these are very important, is a garbage in, garbage out type. If they don't disclose the full right information, then we have this problem. We will not be able to give them the right advice also.
Solution, yes,
Yeah.
exactly. So, but I mean, on the same lines, George, what about risk? How do you assess the kind of risk investor can take? Because most investors themselves don't understand, and very often they tend to be more conservative than aggressive. I mean, traditionally, maybe today's generation sometimes is more aggressive than conservative. So they don't understand their actual risk-taking capabilities.
I agree with you because when you have conversation with the retail investors, uh, they're very conservative. They don't want to take a risk. But their ambition to make returns is also sky high. So actually, that risk return, understanding of investors is very less even today. Even the youngsters, the millions of youngsters in the market today, they have only seen a bull market. They have not seen what it is a bear market. I'm talking about last 5, 6, 7 years.
Right.
So this is standard conversation that we have with our own people. They tell us the same thing. They want the highest possible return, and their risk taking capacity is very low. When I talk about risk taking capacity, a lot of people may have the capacity to take risk. Their risk bearing capacity is
Low.
low.
Right.
So mindset wise, they cannot, they don't bear with a situation of any kind of significant mark-to-market losses, and
Right.
they cannot wait. And this is a big problem for retail market, and because of this, if we correlate with the current situation, I think there will be some amount of pain when the market corrects.
So how do you actually then add value to a package that you offer a customer? I mean, I would suspect that when a customer enters into to creating wealth for himself. You put him first through mutual funds, and then you put him through other products that you have, and you yourself offer a basket of strategies. So sometimes it's very confusing for an investor. Should I be in a mutual fund? Should I be in a portfolio management service, a set of basket of strategies, or should I invest on my own? Because very often investors graduate to a stage where they say that now I understand the market and maybe I should get into equity. So how do you advise the investor through this journey?
So it is definitely not easy and simple. Um, we advise them mostly, you know, most of the people to start with an SIP.
Okay.
I'm talking about the new investor. Start with an SIP and see what happens in the market through the SIP, and then graduate to, when they have surplus, graduate to mutual funds. Once they start developing a good understanding on mutual fund, that is the time the conversation moves to whether they can take a little more risk, whether they will look at a basket of stocks or some individual stocks. Some of them come with their suggestions on what is your opinion about this stock, this company. I know this company very well. I heard of this company. So, what is your opinion, etc. They tend to ask this question. So invariably, our conversation with a new investor is starting with SIP or mutual funds. Only when they graduate as a relatively knowledgeable investor, we talk to them on stocks, individual stocks or basket of stocks. PMS, of course, is for the high net worth clients. There, the conversation, in my understanding, is relatively easy and less complex. Number one, their risk appetite is high, and then they are high net worth investors. Their understanding is relatively better. So, with a retail investor, our standard advice is also this. And then we also train our people who are customer interfacing on one thing, that is day in and day out. That is the purpose of our own existence. What are we doing and why are we here? We are here as an investment services organization not to make money for us. We need to make money for our clients, and that is paramount. Uh, this training is important because they need to manage conflict every day, conflict of interest. Uh, Particularly clients coming for brokerage transaction. When they do a transaction, we get revenue. So there is kind of an inbuilt conflict in that there could be a tendency to go for a transaction sometimes when it is not necessary also. So this uh, instilling of this mindset of purpose, this is what we do day in and day out. My job as the MD of the company is going and meeting our people and always talk about this. If the clients are not making money, then our purpose of existence is defeated. So this is how we manage the
In
situation.
fact, this entire professional consultation practice that you have, you call it STEP, if I'm
Oh,
not
yeah,
mistaken,
okay,
right? And therefore, you take them step by step
absolutely.
through this financial journey. But coming back to the first step, of mutual funds itself. Now, today there are so many mutual funds. I mean, you got 45 mutual fund houses. Each of them have a plethora of schemes. You have the broad diversified schemes. You have the sectoral funds. You have the thematic funds. So how do you help in this process that you have, this step process that you have? How do you help them navigate that space?
This is an interesting statement. This is also confusing a lot of these investors, and that is why they are coming to us instead of going direct. They
Correct.
also know today how to invest. They can go directly and buy mutual funds and all. So then they see this plethora of schemes and the AMCs. Uh, so they don't, and then their returns are also probably at varied levels. So they are confused. They come to us. And in the financial planning process, we have this steps process. Uh, that is where we ask these questions. We basically understand the goals and then prepare a plan for achieving that goal. And then they will also have the retirement plan and all that. So with that, we prepare a financial plan for them, and then we handhold them.
Okay.
So that is the step-by-step approach, actually, what we are doing in the financial plan.
So, do you think it's a good idea for a first-time investor, say a young 25-year-old first-time investor who wants to participate, in the markets and wants to sort of start building wealth for himself, to first get into, say, a diversified equity fund, and then from there move on to, other funds as he understands this space better?
Absolutely. We actually advise these new investors to go for, large cap or diversified, because their risk appetite also will be low. And in case, if they go and invest in some small cap scheme, and when the market corrects, if they lose money, they will get out of the market. We don't want to lose them from the capital market. We want them to be there in the market, continue investing for a long period of time. So we are very, very, very careful about this. Our advice is always on either large cap, diversified large cap schemes. There is absolutely no doubt about it.
So, going, taking a slightly different tack, you had mentioned earlier in this conversation that you were one of the pioneers in the internet banking space, right?
Trading.
So, internet trading space, my bad. And uh, as you evolved, you did not go down the route of becoming you know the digital broking house, or go completely the digital way. You chose to embrace the phygital way, where you said, I'll have a physical presence, I will also have a digital platform that will enable trading. But I think both are important, and we need to sort of marry the two. Could you just tell me why that idea came up, and why do you think actually it has an advantage? Because today, the discount brokers who offer this digital model, have garnered a huge number of people to trade through them. And why is it in the interest of the investor at the end of the day to go through a phygital model rather than a digital model, in your opinion?
Uh, I'm not underestimating the power of digital space. I think the people who are knowledgeable, who can take their own decisions, those self-directed investors, they can directly use the digital, platforms. There is nothing wrong in that. But majority of people, vast majority of the people also need some kind of handholding. Now, coming back to this topic, we were the first broker in India to start internet trading in 2000. Then SEBI chairman had inaugurated this. Uh, I mentioned to you the fact that we were dealing directly with the customers. So we had large number of customers with whom we deal directly. So if you deal only with the sub-brokers, then they are aggregators. So number of sub-brokers will be less. So in our case, it was slightly different. So we understood the need for internet trading platform at a very early stage itself. Because of this, we did not have sub-brokers. We were dealing with the clients directly. In our main office in Cochin at that point in time, I still remember, there were around 35 lines. So this was also the time of the dot-com boom.
Mm.
Even with the 35 lines, between 9 o'clock and 10 o'clock, invariably clients used to complain, they don't get our line. So they don't get the right price. So they are unable to talk to our dealers. So we were under pressure to come out with some solution for their needs. And that is how we thought that we must provide this platform, which can basically, give this facility
You
to
can
any
scale up.
scale up. Any
Yeah,
number of
right.
people could log in and they can see the rate, they can trade on their own, etc. So this was the background of that. But we never ever imagined that we wish to deal with the faceless clients. Our DNA is to see the face, have the conversation, understand the requirements, and then advise, then execute. So the uh, basic difference between you know a pure digital discount broking model and our model is, in that model, a transaction is an end. In our model, it is only means to an end.
That's very
Our,
interesting.
yeah,
Yes.
our aim is basically one, that is our clients have to create wealth. So towards that journey, transaction is only a minor, you know,
Right. It is just one step in that
one step in the
right.
process. So we always believed that this is what we need to do. We will use technology and the best possible technology for customers who come there, execute trades, but for their service. And we also understood the the difference. The customers who come to us, they are with us for years, and we also have second generation
Right.
clients from the same family. Now even third generation
Right.
started investing from the same families. Whereas 85% of the transactions in the market are executed online only.
Right.
85% is online, but we are not a discount broker. We are not a pure digital broker, and we have a lakh plus crore of customer assets with us. We also know one thing, that they may not even come to Geojit office, but the knowledge is that if something goes wrong, I can go to that corner and shout at that Geojit person.
No.
That comfort is very important in the wealth creation journey. This is, even after spending so many years in the market, I have no change in my opinion on this particular factor. Wealth is, and their assets, it's very important for them personally, and they want to have that meeting and want to understand if they have a complaint, uh, grievances. They call up the office, they come to our office, they speak to our people. That's a huge comfort that is driving people to us.
Which, if I may go down one of those rabbit holes from what I heard you saying, you talked about three generations who have been sort of you have been associated with, and have been sort of managing their portfolios and advising them. My question is that people who've got generational wealth, do they have the ability to look at risk differently? Do they take more risk when they invest? What is your observation?
So I can tell you about many cases where I have seen, these are people, the first generation customers, they were dealing with us for picking up individual stocks.
Right.
Uh, and they were patient investors also. Their horizon, investment horizon, was much larger. And many cases in the second generation, they are today either our mutual fund customers or PMS customers, because they also have busy engagements elsewhere.
Right.
They don't want to take effort in picking stocks, etc. In our last 35-year anniversary celebration, one of them came and spoke to all our employees, the second generation, who is a PMS customer, and he said which I did not know, he said his daughter is also a customer, and his father started with a trading account and trading stocks, but he is only doing PMS. His daughter is investing in stocks. So their risk appetite is different, knowledge levels are different. But one thing,
So you think the knowledge levels have improved
improved,
dramatically?
improved. Knowledge levels are definitely improved. Only thing what I have noticed is those years in 40, So I started in 1984. It's now 40 years as an employee in. I started as an analyst, and then from the days I started the business, I have noticed one thing which is very, very significant. Uh, those days, it is in economics, it can be called the unintended consequence. The transaction cost was very high.
Right.
So somebody in say Cochin will approach a broker in Cochin to sell a share or buy a share, and he will execute in Bombay Stock Exchange for Bombay trade and all that. So something like 7 to 10% transaction cost. Uh, I'm talking about round trip cost
Right.
for buying and selling
Right.
was usual. Between you know the
Right.
jobbers were there in the market. The jobbing is always 95 by 100 seller.
Right.
So you always sell at 95 and buy at 100. So there is this difference. So those days nobody. I was kind of dealing with the clients. Nobody used to purchase a stock, invest in a stock with an expectation to sell in 6 months also,
Okay.
or maybe 1 year also. Their investment horizon is
Simply
such,
because transaction costs
cost
are
is
so
very
high.
high.
Exactly.
So it is a
So
very,
now the transaction costs have come. It has encouraged trading. Is that the point you're trying to
absolutely,
make?
absolutely.
Okay.
One of the reason is that now even if it is, they some of them want to buy and sell in 10 minutes, 15 minutes, 1 hour kind of this, because the cost has really come down. This is an unintended consequence of huge decline in the transaction cost. While I am of the view that it is not bad, it is good, but this has happened.
George, just to follow up on what you just said about the next generation being able to take more risk. See, today you have almost 15 crore demat accounts, and most of the young people, as you were saying, are into intraday trading. If you look at derivative trading, for example, like almost 43% of this entire derivative trading is by the retail investors. Why I ask you this question is you did a very interesting thing. You went in for one of those mass media campaigns, outdoor campaigns, you know trying to educate people as to what are the pitfalls of derivative investing and why they should understand the risk in that. So could you just tell us a little bit about what prompted you to do that? Did you see this becoming a big problem?
Yeah, interesting question. Good that you asked me this question. This was in 2015. Uh, that time derivatives market was much smaller, but still big at that point in time. We did a study. We were one of the pioneers in derivative market education, etc. We did a study of what happened to clients who traded from 2010 to 2015. And then we also did the similar study on equities as well as SIPs. So what we found at that time was exactly same like what came out in SEBI study. 90% of these traders were losing money
In the derivative
in the
segment.
derivatives. And when they lose money, they get out also. So the first thing we did was we reduced employee incentives by 50% for derivatives business income. If it is if it is offline, online we didn't, but offline derivatives income, employee incentive was reduced by 50%. And then we also saw another thing, every single SIP, 100% of the people had made money
Made
on,
money.
made money. And that is the time we decided to go for a strategic shift in the solutions that we should be offering to retail clients. And thereafter we decided that this is not good for retail investors and we should not be aggressively promoting derivatives at all. People today start trading in options first with no understanding of the underlying.
Without even looking at mutual funds or
No,
equity, just
no,
get into
no,
options directly.
no. Underlying stock also. They
Okay.
don't. They have no view of the underlying stock. They just start trading the options. So this is, and then they are losing money. Not that there are, not that people, everybody is losing money. There are people who are using, skill, their own skill, some algorithms, some strategies, who are taking effort in trading and knowledge based trading. Some are making money, but vast majority of the people are losing money. So we thought it is against the interest of long term sustainability of the capital market itself, because when they lose money they get out of the market, and then they will not come back come back to the market for many years. This we learned in 1992 when the scam happened. So we were very careful that this should not be happening this time. So we did a massive outdoor campaign in the state of Kerala. Kerala is one market where we have significant business. We thought of starting with Kerala. Next year we plan to do this in Tamil Nadu also.
So did this have an impact? Have you been able to measure whether it did have an impact?
Uh, it was very difficult to measure exactly. There were some talks we could,
Yeah. If
feel.
not anything else, people start talking about the
Yes,
fact that derivative trading is risky,
absolutely.
and you need to understand this market before you do.
Absolutely. And most of these youngsters who were newcomers, they were trading in the market, trading in options without understanding the risk, and they were losing money. And we were educating people, come on, you invest in SIPs. You have this small amount of money. Don't throw this money, unnecessarily as a waste. You invest in SIPs, and and we teach them power of compounding,
Correct.
basically to make them convinced. And today we have, after almost 10 years of this exercise on SIP, today we have a community of people who have created wealth only through SIPs.
Okay.
So this is something, very important question you asked.
Good.
We,
So I think the fact is that you necessarily have to have some understanding of the derivatives market before you get in that, and don't just treat it as pure speculation.
absolutely.
Going down another track, George, which you've played a very important role in, and that is the overseas Indian, the non-resident Indian. You have, I think, the among the Indian companies, the largest franchise in the Middle East. You operate out of Kuwait, Bahrain, UAE, Saudi, and many other
Oman.
countries, Oman, and many other countries out there. My question is that how easy or difficult is it for a non-resident Indian to invest back into the Indian financial markets, mainly the equity markets, but if not the, no, if, but beyond the equity markets in other markets, what are the procedural hassles that they have over there? And I have another question also associated with this. Why Indian markets? Because they have access to global markets out there. You have, what do you call it, investment advisors who are, selling them the American markets, the European markets, and why Indian markets? So, two questions.
Interesting. So, uh, NRIs have definitely difficulties in accessing Indian equity market directly in trading. In trading, one reason is that they are also clubbed along with the uh, foreign FPI limit
Right.
and or foreign
Correct.
shareholding limit.
Correct.
So there has to be monitoring. So because there has to be monitoring, they have to necessarily open this PIS account. So even if it is 25,000 rupees investment into Indian equity market, they have to open a PIS account. Once you open a PIS account, even to change that PIS account to another bank, it's almost impossible. You need an NOC to shift from one bank to another bank, which doesn't come
Right.
very often. So, and also the tax related difficulties. So, it is not easy for NRIs to basically access the market. So, you asked this question, why India?
No, before you answer why India, so how do you make it easier for NRIs to invest into India? What if you've got a very large franchise out there, I think 30-35% of your entire business comes out of that market. So I think you must have put in a lot of effort to make it simpler for them to access the Indian market.
Uh, yes, we tried our level best, but then what we did was we opened, similarly like India, we opened our offices through various joint ventures because there were local
Right.
laws and constraints. So we opened joint ventures, we sent our people there and all that. You know, today to do KYC, online KYC is not possible. So the problem starts with account opening itself. So it is not easy, it is not possible for people to open account directly online. That's a very big major
Are
constraint.
we making any moves in that direction?
We have been, basically talking to, when stock exchanges have been talking to Government of India, we have also been writing to regulators. Regulators may have other concerns on this. Possibly this might come through. The moment KYC becomes online, you know, for example, take for example UAE, we have around 60 people, 50, 60 people working in UAE. We have branches in Abu Dhabi, Dubai, Sharjah and all. But there are people in the interior. For us to, basically go to them to open an account, or for them to come to our branch to open an account, it is a story of Geojit having branch over there. Our competitors, they don't have branch over there. So they are also not getting clients. It is not easy. When they come for holidays, they try to
So what do
open
you
a
think? While online KYC is available to a
domestic.
resident Indian domestic investor,
Yeah,
it is not available to a non-resident
correct,
investor, and you believe in course of time this will happen.
correct, correct.
And coming back to the second question about why India,
Yeah. Oh, okay. So there are two major reasons. One is geography wise. For example, in the Middle East, uh, and the Indians, that's the biggest diaspora.
right.
Uh, they cannot get citizenship, or if even if they get, these are all, two, three, four, a dozen or so.
Right.
So people don't get citizenship. They start with the assumption that they have to come back to India one day after retirement. So they start building, assets and wealth in India. That's an important part of their financial plan. So they basically invest in India. So this is what is happening in Middle East.
Because they are returning
They are
Indians.
returning Indians. They
But you
have
also have some people who are non-returning Indians. So
correct,
what about for them?
correct. They are the people in the West. So in the US, of course, we have limitations today due to, you are aware, due to regulatory constraints. North America is kind of a no-no, unless there are special situations, kind of. Other places, these are people who are settling down there. They are looking at India, luckily, as the country of opportunity. They have some investments in their own countries where they work, but they consider India as the land of opportunities, a market that is well developed, a regulatory framework which is possibly, if not equal, better than developed countries. This is giving lot of comfort to Indians in developed nations to approach Indian intermediaries to invest in India. I think these are the two different types of investors
Right.
who have different approaches.
Talking about that, among the investment products that you sort of offer to some of your Gulf investors, especially, is an ethical portfolio.
Yeah.
My question is that ethical portfolios could have limitations in where to invest and where not to invest. But sometimes you do see that ethical portfolios perform very well in the long run. What has been your experience with this ethical portfolio?
No, first of all, ethical portfolio is for largely for
Domestic investors also.
domestic investors
Okay.
also. There is no
Yeah, it is
difference.
not. It is not offered only to the
No, no, no.
overseas
No.
investors.
So our experience is that there are some people who are looking at, just like ESG. Some people
Correct.
are very focused on ESG based investments.
Correct.
And similarly, there are some people who are looking at ethical funds and ethical portfolios. It is not significant in my view, because vast majority of investors, they look at returns predominantly.
Right.
uh, and if some documentations are also there to get some certifications, they are happy with it. But otherwise, I think they go by the
Yeah.
returns. But your statement on returns,
Right.
that is absolutely right. So we also have a PMS scheme which is doing very well, even with its constraints. That means India is a country with an opportunity to construct even ethical portfolios as successful competitive investment avenue. So uh, I think you are right.
So over lunch, George, you were telling me that you're now involved with sustainability. So any thoughts about ESG portfolios? You just mentioned them. Do you think they are ESG is a space where there will be a lot more money that will flow in, lot more funds to manage in that ESG space?
I think it is too early. I don't think today's investors, particularly retail, institutional investors, yes, due to their uh, other mandates, etc., yes, we can see. Retail, we seldom see, maybe due to lack of awareness uh, or lack of consciousness on this. Retail, I am not seeing traction.
Right.
But this is something, some leadership initiatives we need to take, basically to educate people on, ESG, etc. So it's long time. Only baby steps that we can take now. That's my view.
A couple of quick questions, George. One is technology, because there is so much of technology that's come into financial services. So, do you see technology changing the face of how people will approach investing? AI-driven strategies, robo advisors. How do you see that space? And you were the pioneers in internet, so I'm sure you're going to be the pioneers there too.
Yeah. Yes, it is very tricky. Globally, AI is likely to change the way intermediaries are providing service and selling products. There is no doubt about it, because that's a good engine to understand and analyze the requirements of investors in a faster way, and then at similar speed we will be able to provide solutions also. So AI will have long term significant impact. We also, uh, a robo platform is something that we also tried, and we have seen people coming in, looking at it, tasting it, and then giving it up.
So, going back to the phygital model,
Yeah,
they want to see a
exactly.
face at the end of that advice.
Exactly,
Correct.
exactly. And some people would have taken, for example, we uh, did limited financial planning through
Robo.
robo model, and some people did take financial plans, and possibly they were practicing on their own. We don't know, but some people definitely converted themselves into digital.
Right.
They started taking advice. So my view on this, after spending a lot of focus on technology, is that people also need uh, a kind of human interface when they need it. They may not need probably once in 5 years, but that their need is very, very evident. If I want, I need somebody to,
Correct.
that is something still there.
In the investment,
Yeah,
in
yes.
creating wealth, you need that. Yeah. So the second question, George, was with so much of democratization of information, right? Do you see volatility increasing substantially in this market? Because today there is so much of information. Every minute, there is some information that's hitting you, and people tend to sort of react to that information.
It is definitely a problem, information as well as misinformation.
Right.
Both are having its play in the market. We are seeing this, the way we get questions from clients, the feedbacks from clients, why do they trade, why do they take decisions, both are acting. It is definitely creating some amount of volatility.
And a question which I think I did ask you in a different way a little time back. There is increased prosperity definitely in a country like ours, which is growing, and with increased prosperity, this ability to take risk, the ability to sort of, as you said, trade and look for instances, that also increases.
Yes.
So how do we as advisors sort of approach this, and how do we sort of advise our customers that there is a you need to have a different approach for creating wealth for yourself?
Yeah, luckily, I think uh, we have today data of cycles and people who continued investment through many cycles. And there are also set of people who left the markets when there was a downturn. They have not created wealth. The people who stayed with the patience, they created, unbelievable amount of wealth. So today, luckily, we have data, and that data, when we give to the clients and then talk and show the data, there is huge amount of acceptance. So that way we are much better off today. When we advise clients, we write to clients, we always want them. Today, one such situation is the exuberance that we see in the market. Uh, this is not something that can continue forever.
Right.
So what happens is also a talking point today for us. In our conversation with our clients, we also talk about this exuberance. We don't advise clients to, already started talking to clients, even for mutual fund investment, we are not advising to make lump sum investments. We are advising people to put it in liquid funds and then do an STP, come through SIP, and how it will play around.
Right.
We show the data. So that way, today we are able to convince clients. We have data to convince
Yeah, so
clients.
the good old adage which says it's not timing the market, but
No,
time in the market that will create wealth for yourself.
absolutely,
Right.
absolutely.
So, in conclusion, George, I just wanted to touch about one subject. We were talking about Rakesh Jhunjhunwala and your association with him, and I remember when he just about entered Geojit around 2005, he made this prediction which actually brought him into the limelight, where he said that index at 5,000 in the next 4, 5, 6 years, it's going to hit 25,000. The index never hit 25,000. It hit 21,000, very, very close to what he said it was, and then corrected and then went back to 21,000. But he was very precinct over there. And, he did say, I do remember, 10 years later, almost 10, 15 years later, that I now see the Sensex going up to something like, 1,25,000. We're still somewhere there. I mean, we've moved a long way. But could you just share with us, that one sort of interaction that you had with Rakesh, which stands out in your mind, which could be a sort of good pointer to investors? Many of those things like the power of compounding, time in the market, which all these things which you have been talking about. Is there anything that you thought, struck you as something that we should leave as a message to investors?
So, for example, Rakesh has always been a disciplined investor. He was an active trader also. That is, these are two different
Personality. Okay,
personalities, two
correct.
different personalities. And he made money in both. Very seldom we see such people. And he made money in trading also consistently. But his view on the market is also coming from, if my understanding is right, is coming from his conviction with regard to the market and India's economy and India's future. That conviction was also the reason basically driving him into this conclusion. And he was very, very optimistic, and he could always foresee what we are seeing today. That is, the retail investing public, the retail savers, they are significantly directing their surplus to equity markets, financial markets, which even today RBI is also concerned, it looks like. Bank FDs are not growing, whereas equity markets are getting a lot of inflows. So this is also one of the reasons that he was convinced that India has a future which is unquestionable, number one. Number two, Indian retail has this mindset and the risk-taking capability like South Korean market, or for example even Chinese market. We are all Asian society that is prone to taking some amount of risk, and India's strong India story, growth story. These two combined together was basically the reason, in my understanding of what he thought at that stage, is the reason why he predicted something like this.
So I think, if I may sum up, what you're trying to say is, one is that you also believe that the future of India looks very, very bright. But if you really need to make money in this market, there are one or two things that you need to remember. The first and most important thing is discipline,
Yes.
right? So long as you stay disciplined and stay disciplined over the long term, you will make money. And two is that you will have to take some amount of risk,
Yes.
right? Because if you do not take risk and you don't invest into risky assets, you will never be able to create wealth for yourself. And those are the messages that you would like to leave with us, George.
Absolutely. And the third point that I must say, that marketplace in India is unbelievably safe today compared to 15 years ago, 20 years ago,
Or 35 years ago.
35 years ago when we first
Correct.
perhaps met also. Uh, compared to that, thanks to SEBI, thanks to Government of India, thanks to all the regulations are not always very comfortable for regulated entities. But fact of the matter is, when we look at the growth of the market, this growth was on this solid, safe foundation of the market regulatory infrastructure. I must thank that also. And
Good.
people like you are playing a significant role in that. Thank you for that.
Thank you so much, George, for being with us today.
Thank you very much. It was a pleasure.